Aloha, good morning. This is Caron B Davis of Caron B Realty, and welcome, Duncan, again. Really appreciate you being here this morning. And of course, we know Duncan is the president and owner of Infinite. Let's start again. Sorry. Aloha, good morning. This is Caron B Davis of Caron B Realty International. Welcome and welcome, Duncan, again. We appreciate you being here. He is the owner of Infinity Financial Services. And I just, I have Duncan back again and again because he's so knowledgeable. He's way more than just a mortgage broker. He's a financial wizard helping clients either getting that dream home or lowering their monthly home costs. So he's very thoughtful, he's great with communication, and he's really on top of what's going on in the world of finance. So let's hear about what's going on in the world of finance and also what we can expect with interest rates moving forward this year.
Morning, Caron. Thanks for having me on. Last time we talked, the beginning of the year, we were talking about what to expect this year. And I mentioned that some of the economic reports were starting to show some weakness, underlying weakness. Even though the headline numbers were pretty strong, you could tell looking deeper that there was some underlying weakness. And therefore, I thought it would make sense for the Fed to start cutting rates this year. I thought later this year, towards the end of the year, we'd see the Fed cutting rates. They have not cut the short-term rates yet, but with the CPI report earlier this month showing actually deflation month to month, so rates or prices actually dropped month over month, and that still includes a high rate of appreciation of inflation on shelter, when we know that shelter, they use lagging data for shelter for rents. So the actual CPI, it has been at the Fed's target rate for quite a while if you don't count the lagging data that they use for the inflation on shelter, on rents, because they use lagging rent data. So with the inflation level being basically at their target rate, and with the economic reports showing more weakness, Friday there was a jobs report that showed much weaker than expected jobs, and unemployment rate was higher than expected. So it hit 4.3%, hit from a low of 3.4% within the last year. And so that has triggered what's called the SOM rule, which is a recession indicator. That's been a pretty reliable indicator of recessions in the past. And so if the economy continues to show weakening reports, it's likely we'll be in recession shortly if we're not in recession already. So you've seen some reaction in the stock market on Friday, and today stock market was down over 1,000 points on the Dow today. And it's probably just a short-term correction at this point. But if once the Fed cuts rates, the market does tend to be a little weaker on the stock market. And then the long-term rates have started to come down as well. So already, because the long-term rates are based on the market expectations and not based on the Fed, Fed controls the short-term rates, the market has already started to price in future Fed rate cuts. So we had a high last October over 8% on the 30-year fixed mortgage rates on average. And now they've dropped well over 1.5% from there. Now we're at average of 6.34% on 30-year fixed. So it's dropped quite a bit just in the last few weeks on the weaker economic reports. So we're in an environment where the housing prices are still pretty strong. As I mentioned in my past videos and interviews, I expected the housing market to stay strong, and it has. We're nationwide, we're at all-time highs on home prices. Volume is lower because you have really low inventory, and locally we're still near record highs, and I think we're going to stay in that environment where home prices will stay strong because of the demographics. We've got the millennials reaching home buying age, and you got baby boomers that still own their homes. So we've got a dearth of supply, not enough inventory for the huge demand of the new home buyers coming into the market, and especially here in Hawaii, where we have such a little permitting for new homes, where we just don't have enough supply for the demand. And meanwhile, we have interest rates are starting to come down, and I believe that we'll still see interest rates trend lower the next couple of years. The Fed has their projections for short-term rates is that they're going to make a bunch of cuts in the next couple of years and actually lower the Fed funds rate by at least about a couple percent in the next couple of years. And we're going to see that reflected in the longer term rates and in the mortgage rates. It's not going to be in a straight line, but the trend will to see rates drop in the next couple of years. So people buying in the last couple of years will be able to refinance during the next couple of years, and they'll be able to lower their home monthly costs by doing that. Some other trends that we've noticed in the real estate market here, insurance costs have been going up, not just here, but in other states too. But insurance costs for homeowners, my single family home insurance costs went up quite a bit. And a lot of the insurance costs for condos have gone up quite a bit as well. And so that's been an issue with a lot of the condos not wanting to pay that much, that sometimes they're having to pay 10 times as much for the premiums to get the full coverage on the condo insurance. And a lot of the condos, about half or even a majority of the condos here on Oahu, the master hurricane insurance doesn't cover fully the condo. We never had a condo get destroyed by a hurricane here in Oahu, but you never know what's going to happen. And the conventional loan lenders do require, and all the local lenders, they require the full hurricane insurance coverage. But a lot of the HOA boards are deciding not to do the full coverage because it just isn't cost effective to do that. They'd have to raise their maintenance fees a huge amount in order to do that. So a lot of the condos are not doing that. We can still do loans in those buildings, but we're doing a lot of loans that other lenders can't do because all the local lenders and most national lenders are not allowing the closings on those buildings that don't have sufficient hurricane insurance. And it's other types of insurance as well. With all the catastrophes we've had, a lot of the insurance companies have had losses. So they raised their premiums, especially on hurricane, but on other things as well. So we see a lot of the buildings just don't qualify for regular conventional financing. So we're having to use lenders that are okay with that financing. Sometimes it's going to be at a higher rate, but we can finance those transactions. So that's some of the biggest things that we've seen recently. Higher strong home prices, lower sales volume, rates dropping, and more difficulty on getting condos approved, and just insurance overall being a bigger portion of the cost for people.
You know, one of the things I see, it's just so much more expensive to either own a condo or a home right now, you know, and I think that's contributing to the recession too, is people are finding that it's more expensive than what they thought, you know, taxes, insurance, electricity. I mean, everything's just gone up substantially over the last year.
Yeah, actually, over the last 5 years, we've seen a huge jump up in inflation. And most of it was due to the COVID and with that shutdown and with the bills that the government came out with, increasing the government spending and basically giving money away to people that weren't working and just giving away all this money, that causes the money supply to increase. So we saw a big spike in money supply over the last 5 years. And actually over the last couple of years, it has stabilized and we haven't seen the big increase, but inflation lags. So it takes a couple of years before you see the inflation effects in the economy. So the inflation spike peaked a couple of years ago and it's been coming down ever since. And the Fed was way too late to start increasing the rates, and they're way too late to start cutting the rates. They should have been cutting the rates already because they don't need to be that restrictive. They don't need to be that high because inflation has been coming down consistently, and it's a lagging effect. So their rate cuts now, it's going to affect things in the future, but they're probably too late to avoid a recession. They're just way too slow to react, and they were really slow on raising rates and too slow on cutting them too. So we'll likely see cuts. The markets are pricing in that they're going to cut by 50 basis points next month. And there are people that are starting to speculate that they might do a cut even before their next Fed meeting. So they're behind on the rate cutting, just like they were behind on the rate increasing as inflation was going up.
Well, thank you. Appreciate, you know, I know everyone's heard, you know, there's been a lot of news on the interest rates and, you know, on the economy. So it's great to get a very, you know, spot opinion from you that you go, oh, okay, take it away. And that's what I've been feeling, or that's what I've been seeing. I mean, it
Yeah,
definitely sums it all up.
I mean, but the recession that we're likely going to get is likely going to be shallow. We had the unemployment rate increase and that SOM rule trigger, but it's triggered at the lowest unemployment rate ever, because we hit the lowest unemployment rate ever at 3.4 nationwide. So getting up to 4.3, you still have over 95% of people employed. So it's not like in 2008 where you hit 10% on unemployment. So it's a much more favorable economic environment than we had back then. And you have people with triple the equity that they had back then in their homes. So you're not going to get the foreclosures and the short sales that we had back then. So it's a much better economic environment than we had back then. But there are still people that they hear about the weaker than expected reports, and there are people that panic. So there's a sell-off in the markets. But overall, the market's in much better shape than it was 15 years ago in 2008. However, we do have a much higher government debt than we had back then. So longer term, that's something that will need to be addressed, and it's not likely to be addressed by the current government, and unless they make some drastic changes, and the future administrations and Congress start balancing the budget better, we're going to see this growing debt, and that is going to become more and more of an issue, and it could cause some economic dangers in the future.
Absolutely. Well, thank you so much, Duncan. And of course, we'll finish today by sharing Marianne's photos like we like to do every morning on Friday. And just here we go. And what she defines this as is luxury comes in many shapes and forms. And of course,